Let's delve into the numbers. I suppose we've also got to take into the fact that base effects are also to perhaps blame for the fact that we've had inflation coming down for the month of March. Just run us through your views on the inflation picture as it stands right now.
Yes, good day, Samantha. Yeah, I think there's definitely two issues at play here. Firstly, inflation did slow from 7.4 year-on-year last month to 6.9. And as you correctly state, there's two issues to this. The one is the rebasing effect from last year, where we had very slow inflation growth. And then this month as well, we recorded lower than average month-on-month inflation. So it was basically two sides to the same coin.
If you just delve into the inflation index, of course, you've still got food price pressures, which have been highlighted as a concern. The transport index declined slightly to 8%, but overall, a lot of the factors which have been driving inflation are outside of the control of the central bank. What are your views on the implications that the latest inflation numbers might have for the inflation outlook, and then perhaps the outlook for interest rates? We know that repo rate has been on hold for some time now.
Yes, currently Namibia's repo rate is at 6% for quite a while now. Next week we have another Bank of Namibia meeting. We don't expect any changes in the repo rate. As you correctly state, most of inflation is of a cost push nature, so we don't expect any strong reaction from the Bank of Namibia's side going forward for the foreseeable future.
Let's look at the government's borrowing plans for the year going forward and how the market has reacted to that as well, because those numbers came through last week Friday. You're looking at the government borrowing $2.6 billion in terms of its targets for this year. If you strip out redemptions, that amount is around $1.9 billion. Just run us through where government is predominantly going to be borrowing this money.
Well, all of the borrowing will take place on the capital market or the bond side. As you state, 2.6 billion, and then this year we also have the GC12 maturing, of which 50% or around 680 million will be redeemed. The other 700 million of the maturity will be rolled forward. Predominantly, we see that about 1.3 billion will be issued somewhere between the 5 and the 14-year space. And what's exciting for the South African listeners will be the 700 million that will be listed on the JSE. Even though we don't know exactly what the tenor will be as yet, they did indicate that it will be somewhere in the 10-year space.
As you say, planning to raise money on the local markets here in South Africa. We know that many investors really looking for opportunities to get exposure to Namibia's economy, so that perhaps could be one way. Also looking to list another further bond in 2013, 800 million rand. Do you think that's a good way to get exposure to Namibia right now? Are there other avenues that would perhaps be more lucrative?
Well, I think definitely tapping the South African market, which is much deeper than the Namibian capital market, is a good idea. So the government will be testing the waters now, firstly with 700 million, and next year around 800 million on the program.
In terms of demand for local bonds, where have you seen the most activity across the bond spectrum?
Well, most definitely on the shorter end, the GC14, GC17, they receive very good interest in auction. GC27 and GC30, our longer dated bonds benchmarked against the R186 and the 213 in South Africa, they receive slightly less interest, and going forward we do see some pickup in interest there, but looking through this year and into the next fiscal year, we see that borrowing will pick up significantly on those two tenors, and that will obviously have an effect on the spreads.
As you say, just looking at those spreads and benchmarking them against South African government bonds, looking at around a spread between 95 basis points up to 120 basis points if you're looking at the 2030 bond. So in terms of spreads, are you looking at those spreads widening towards the end of the spectrum?
I think probably for now we will still see some relatively stable spreads going forward for the next few auctions. There's only 30 million on offer for the GC27 and GC30 planned for this year on each auction, which will be on every second month. So I think for now the spreads will widen only marginally over time. But as we get closer to the next fiscal year and as we get more clarity on the amount that they will issue on the new bonds, we can see that the spreads will most likely widen still.
In terms of demand, though, because we have been talking about the demand and the reaction to that, you've got government looking to issue or raise $5.7 billion from the market in 2013-2014. So that's quite a large jump from the $2.6 billion that they're looking to raise this year. Are there any concerns around sustainability of that borrowing and the funding requirements in terms of financing that borrowing?
I think firstly it's important to note that the amount that government wants to raise this year is already less than anticipated this time last year, and mostly that was due to the fact that the spending didn't occur quite as fast as government had hoped. So you still have to see closer to the end of this fiscal year if government has spent efficiently enough to actually borrow the 5.7 billion next year.
Ian, thank you so much.
But definitely on a on a sustainability basis, our general debt to GDP levels are still well within range and well within target. So it should be able to be sustainable in the short term.
And on that note, as you say, the government is citing the fact that they're looking at debt to GDP sitting at 35% for 2012. Ian, thank you very much for that update. Ian Erlank, Chief Investment Officer at Capricon Asset Management.